So, hey, Junior, what's your favorite asset? Ah, real estate anytime. I would love to buy properties. Oh, real estate. So, if you get lots of money, where would you invest? Of course, property. I'll buy a few more flats. I can make money. I can grow my wealth. Have you ever considered equities? Equities? No, 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 no. Ah, markets go up. Sometimes they are down. The other day, the market crashed on the election results day. Ah, uh, never in equities. Have you ever considered debt? What? Debt? You mean to say bonds? I don't know anything much about bonds. I only know fixed deposits, and I don't want to invest in fixed deposits. Have you considered commodities, alternatives? Commodities? Alternatives? कभी सुना ही नहीं है. What are these? You mean to say they're assets? I can invest? Huh? I don't know. It's never a good idea to put all your money in one asset class. You must invest in 2 to 3 asset classes to maximize your returns, minimize your risk. What happens if real estates crash? What do you do? Oh, I never thought of that before. You make a good point. If all the real estate crash, it's a big problem. Mm. That's why you need other asset classes. Watch this video. I'm going to talk to you about all the different asset classes which you can invest and you can maximize your returns and minimize your risks. Oh, yes, yes. Seems like a very important video. I would like to learn about those new asset classes you talked about, some commodities and alternates. No, no, alternatives. Yeah, yeah, I would like to know more about that. Yes. Today, I will teach you different asset classes, the important asset classes, which can help you maximize your returns and minimize your risks. So hang on. Yes, Junior, hang on. Watch this video fully and you will understand what are the different asset classes, right? And probably by the end of this video, you'll forget your favorite asset class. Let's get into the video. So let me begin with an analogy, as always. We all travel. I'm sure there is no one here who says, I have never traveled. We all travel. We travel, we commute every day. And what are the various modes of transport? If we can classify the bicycle to begin with, autos in India, cars, buses, trains, aeroplane, and in very rare cases, rockets. So these are modes of transport, or you can classify them as classes of various transport. And each of these have their positives and negatives. And what is our goal? Our goal is to reach from one place to the other, best, comfortable way, fastest way, and the cheapest. So we try to combine all these, right? Convenience, money, and also time. So this is the objective of our travel. And there are people who travel so frequently, every day. Maybe there are people who travel once or twice a week by flight. Every day they travel by bus, or every day they travel by cars, right? So, and there are some people who may be taking an auto and a bus and a train. I remember when I was working in Mumbai many years ago in the 90s, 90s, mid 90s, and late 90s. I used to work, I used to go to Mumbai, South Mumbai, Fort, Kolaba to work. So I would take an auto or a bus from my home to the station, Andheri station. From there, take a train, and from there, take a bus, a special bus which would go to Kolaba when I worked with SBI Mutual Fund. And then later on, when I was working in other places, I had to take again a bus, a train, a bus, or maybe a cab, a car, a taxi. So we are all familiar with this, and each of them have their own advantages. And I'm coming to why I'm talking this. I'm coming to the topic which is about assets, which is about investments. And again, to dwell a little bit on these, a flight can help you reach faster, but it is expensive. A train also can help you reach faster, and it is owned by the government. Buses are a good substitute for trains, but have their own challenges. There are no toilets. This is something which I never like. That's the reason I don't want to travel by bus. And it shakes, you can't sleep. But it helps you as an alternative when you don't get train tickets. Something very, very similar happens in many areas of our lives. Many areas of our lives, this happens. And very much in the investment world. And all you young families, this session is for you. As I had mentioned earlier in my last video, I want to dwell deeper into the topic of asset allocation. And I believe this is one of the most underrated strategy, but that can be the most powerful concept for you if you understand it. Remember, we want to save and invest. Savings and investments all are assets. And our goal, your goal and my goal, is to reach our goal of financial freedom faster. So we want to maximize our wealth, taking minimum risks. And that is what is the goal of asset allocation. And our goal is to grow our wealth. As a young family, you are at the right time in history of your life. If you are in your early 30s or late 20s, you are in your golden years to invest, because you will reap the profits. In the next 30 years, you can reap profits. And as I always talk about my mission is to help young families to grow their wealth and their relationship so that they can leave a legacy of love and of generosity. Ultimately, all this money and all that we're talking about, it is, yes, to help ourselves, to our children, but also to be of help to this society. There are many people who can't think of investing. Absolutely. Not just because they don't know, but they cannot. Many. So you and I are in a very, in a sweet spot. We are not so rich that we don't have to have knowledge. In fact, the rich have more knowledge. And we are not so poor that we cannot invest. We have a lot of money. You are a salaried person. Every month you receive money, and that money will help you grow your wealth. यही आपके पास जो पैसा है, आपको जो सैलरी मिलती है, इस सैलरी से ही हम वेल्थ बिल्ड करेंगे, वेल्थ बनाएंगे. Yes. And that is our goal. And that's why this topic is so important. And what I want to cover in the next few videos, I cannot cover in just one of these videos. बहुत सारे videos लगेंगे मुझे. My goal is that you learn, you gain good knowledge. You don't have to have major knowledge in investing, growing your returns, as I have already told in the past. बस हमारी जो knowledge है, financial literacy is very important. Basics are very important, because after all, this is your money. ये आपका पैसा है, मेरा पैसा है, and हमको इसे बढ़ाना है so that we'll be useful for ourselves, for our children, and for this society. So what I'm going to do in this series is we will look at various asset classes. I'll talk about them in a while, and then we will go into depth. We will, for example, asset classes are like cash and cash equivalents, equities, bonds, gold. We'll get deeper into it, especially when it comes to mutual funds. I have worked in mutual funds for 30 years, and I believe there is no better way to invest. Mutual fund is not an asset class. Mutual fund is a way to invest. And I believe it's among the best way to invest, best investment options you and I have. So I'll get deeper into equities, for example, large caps, mid caps, small caps, and bonds, short-term bonds, long-term bonds, long duration, short duration, average maturity, how they are useful for us. So I'll get into deep into each of these different mutual funds that are available in the market as we move along. I'll get deeper into a little bit into stock markets. So our goal is to our goal is awareness. We will not be spending and wasting our time on picking stocks and other things. The goal here is to just understand. And once we have understood, we'll make the right decisions. Decisions which are in our control. Most people spend a lot of times in the stock markets and doing other things. The returns are much less. I don't want us to go that route. My goal is to help you focus on your job, focus on your family, focus on your health, and be aware. Right. So, today in this session, we will actually get into the different asset classes. As always, get a pen, a notebook, and sit as a family. And I want you women who are watching, I want you to grow your knowledge. My wife and I've got two daughters. My goal is that they understand, because most women leave all these decisions on their husbands, and I don't want you to. I want you to be equally financially literate. Yes, and one of my sessions will be women, working women, homemakers, learn learn how to invest. Those will be one of my videos which I will be releasing. So I want you all to sit, both of you to sit together. In fact, in this session, if you have slightly grown up children who can understand, let them also sit. Let them also learn, because this learning will help you. And my goal and objective is for young families. If you already know, this video may not be helpful for you, but I want to help those young families who don't know, because the number of families I have interacted with have made mess of their investments. Those who have money, those who don't have money, all of them messed up. So these are important, very important topics, and I want you to understand. Yes, and if you're new to this channel, subscribe, and as and when you like the content, please give a thumbs up so I would know. And nothing better than commenting and letting me know how did you find it. If you didn't find it helpful, if you want to criticize, please go ahead and do it. Please. I mean, if you think it is good, helpful, has added value to you, please let me know. Okay, so we'll get into this session, this video on different asset classes and how important they are for us in growing our wealth. So before we really get into the details of equities and bonds, etc., let's understand foundationally, right? Conceptually, what is an asset class? And here is a good definition. An asset class is a grouping of investments that exhibit similar characteristics, behave similarly in the marketplace, and are subject to the same laws and regulations. Asset classes are the building blocks of investment portfolios and play a crucial role in asset allocation strategies. So let's break down the definition. Ideally, our goal is to help us understand, to invest and grow our wealth, right? So this is very important for us to understand that they have similar financial structure. For example, equities. Whether you buy as mutual funds or equities, or whether you buy large caps, small caps, mid caps, all that, whatever you buy, they have the similar financial structure, right? They are similar in every sense. Comparable market behavior and reactions to economic factors, right? So if there is a geopolitical situation like Ukraine or Israel, what happens? Equities fall wherever you've purchased from, whether you've given it somebody else to manage the money, whether it is mutual funds, whether it is equities, wherever, they all behave similarly. They're governed by the same rules and regulations, very easy to understand. And generally, they have similar risk and return profiles. Yes, so they have the same risk and return profile, whatever it is, whichever equity it is. They have the same, very same um, profiles. So, what are the major asset classes? If you see here, cash and cash equivalents, we'll talk about each of them in details. Equities, commodities, bonds, real estate, and alternative investments. We'll look at each of them in fair detail, and in the coming weeks, we will we'll dive into each of these with respect to mutual funds, for example, equities and bonds. We will get deeper into the different subdivisions or categorizations within each asset class. So let's start with cash and cash equivalents. And what do you mean by equivalents? Cash and cash equivalents means as equal to cash. Cash is something that you can cash is something that is available immediately. Cash equivalents, they're not exactly cash, but they're equivalents. And we'll look at each of them. So what are the main features of cash and cash equivalents? They're highly liquid, which means you have them at your disposal immediately within a few hours or maybe a day. Low risk, there is no risk with the money, with the cash or cash equivalents. You will get as much as you kept aside or invested, but they have low returns. So these are the three characteristics. They are highly liquid, low risk, and low return. So let's take a look at examples of cash and cash equivalents. Number one, your currency notes or physical cash that you have, physical cash, cash that can be counted, cash that you keep at home. So that is a cash. Then what money is lying in your savings account is also cash, right? You can immediately withdraw using your ATM, or else something that is lying in liquid or short-term mutual funds. Right? So these are some of the um, uh, examples of cash and cash equivalents. So can there be really any advantage of cash? Yes, of course. It may be low risk, low returns, but it has advantages. For your emergency funds, there's nothing better than cash, right? As an example, when you're driving your car in the middle of the night, you have a flat tire, and you call your mechanic or call your car company, and they come, and you have to pay the mechanic. What can you do? What do you pay? Right? You pay by cash or by UPI, something that is immediately available. So it's an emergency fund for your immediate financial goals. If you have to pay your daughter's college fees, what do? Or school fees? It is cash, right? It is what is available in your savings account, or which is available in your liquid funds. Immediately you can withdraw. It can withstand market volatility. There may be ups and downs, market crash, nothing happens to your cash. And another very important thing I believe is an opportunity to invest. When the markets crash and markets are down, those who have cash, and cash is king, those who are cash can actually use that opportunity to invest. So cash has a lot of advantages, more than you and I thought. And of course, it has got disadvantages, inflation risk. The more you keep cash with you, the more you will lose because of inflation. Your purchasing power reduces, and that could have been invested elsewhere. That is the opportunity cost. I know a dear friend of mine who's so scared to invest anything that all his salary, lakhs of rupees, comes and sits into his savings account, and he has done nothing about it. What he's actually losing because of the inflation, he's losing the opportunity to invest, and he's losing his purchasing power. Now this is something I've been talking about: asset allocation. If you do not understand this term,
Watch my video, asset misallocation, then what is right. You must watch that to understand this concept of asset allocation. Asset allocation is basically to ensure that you maximize your returns and at the same time you minimize your risk. Maximize returns, minimize your risk. And cash and cash equivalents are safety nets. Your money is safe. Liquidity management, as we talked about, if you need to pay your fees or some emergency, it's there with you. Temporary holding, parking of your funds. If you if you got a big bonus and you don't know what to do, what do? You're actually keeping it in your cash or cash equivalents like your liquid fund. And risk reduction, there is really no risk. The markets may crash 10%, 50%. Your cash will remain the same. So that is a big advantage in an asset allocation, in terms of asset allocation, its role in asset allocation.
So the next is bonds, which we also call as fixed income. So what are the characteristics of bonds, or you call debt? So they have a fixed income or a fixed coupon rate, for example, 5%, 6% interest rate, which you may get semi annually, once in 2 year, twice in a year. So every year you get that. And there is also a defined maturity, which means it could be a 5-year bond or a 10-year bond. Basically, bonds are something where you are lending to the borrower. So basically there is a fixed maturity. It is like giving, it's like somebody, a friend or a relative of yours, takes a loan from you, and when you give the loan, maybe a lakh, what do you tell them? When will you repay this? When will you repay this? So you may not or may take interest, but repayment is fixed. You decide in advance whether it is, you know, whether you will give me back in the next 6 months or a year or something. So there is a defined maturity. There is also a credit risk, which means the borrower may not be able to give back, repay your money. That's a credit risk. And also there's an interest rate risk. So in reality, in the markets, when the interest rates go up or down, that affects the bond prices, the value of the bond. There are some of the examples of bonds or debt instruments are fixed deposits, right? Your bank fixed deposits, or company fixed deposits. They are all fixed deposits. They are for a month, 6 months, 1 year, 5 year. So they have defined period. They have a interest rate, 5%, 6%, right? They have an interest rate. And corporate or government bonds, right? When companies borrow from individuals, when borrow from mutual funds or borrow from other corporates, so they are called the corporate bonds. Again, they have interest rate, they have a defined maturity. So corporate, or government also borrows, that is also called as a bond. And then you've got debt mutual funds. So debt mutual funds are bond mutual funds which are actually investing into corporate or government bonds. So these are some of the examples for us. So as a retail investor, these are some of the options that we have. So what are the advantages or importance of them in a portfolio when you purchase? It generates income. Definitely it gives you an income. It preserves your capital. Now these are very important, because when you're investing in bonds, fixed interest, risk is very low, your volatility is low, so you get back your capital, right? Diversification, it helps you in your portfolio to have a diversification, different asset classes, and it has stability. Bonds or debts are stable, they keep going up linearly, there's a very little risk of being volatile. So overall they are very stable. Now, as for any other asset class, there are disadvantages. What are the disadvantages? There's an inflation risk. If the interest rates go up, or if the inflation goes up, and if your bond is less than the inflation, it's a risk. For example, you get a bond at 7%. And if the inflation goes above 7%, 8 or 9%, then your bond is not giving you that much interest as much as the inflation. So there's an inflation risk. There's an interest rate risk, which means if your bonds have an interest rate of 5% and the interest rates go up in the market, your bond loses its value because there are other bonds which are available at 7%. So your bond, which is 6%, loses its value, or the value reduces. There's a credit risk, and this is very common for bonds, where some of the companies which may not be very well established companies, or good companies who have a cash crunch, who do not have cash coming in, there is a credit risk, which means they may not be able to pay your interest or your principal. And this has happened especially during COVID. Lower returns. The disadvantages of bonds are they give you lower returns compared to equities, or maybe gold, right? So there is definitely a disadvantage. Finally, what is the role in asset allocation that we are talking about, where we want to maximize the returns and minimize the risk? It's a source of income, definitely. Risk mitigation. When the markets are crashing or falling, uh, there is definitely having bonds in your portfolio minimizes the risk in your portfolio, and it preserves your capital is preserved. So whatever may be happening around, your capital is preserved. And there is a diversification in your portfolio. You get a chance to diversify is basically having different asset classes. So debt have a very important role in asset allocation, because they are really stable, give you interest, and they are not so volatile. So next in the queue is all-time favorite, equities. So what are equities? How do you understand equities? We only think about stock markets and growth, and growth in your assets. But why is it so? What is equities really? So equities or stocks represent ownership in a company, which means when you buy equities, you become a part owner, a co owner in the company. Isn't it wonderful? You don't have to work from scratch. You don't have to think about, you don't have to have any expertise. You just need to have some money. You don't have to have lots of money, a little money. 500,000 rupees is also good enough. Shareholders benefit from the company's growth and profitability through price appreciation and dividends. The way you get returns on your money is your money grows in appreciation, and also you get dividend. Now, what are the characteristics, if you have to distinct, how does equity look different from a bond or a cash? Ownership stake. Unlike bonds where you are lending money, equities is you become a owner. You part own the company. And equities have the potential for growth. Maximum growth happens in equities. You also get dividends from the company when they distribute their profits. And it's also very volatile. There is nothing as volatile as equities. On one hand, it gives you great returns. On the other hand, there is volatility. And that is the price you pay. And obviously, when it is volatile, you cannot sell it immediately. You have to wait for many years. Now, what are some of the examples of equities? Large cap stocks, mid cap stocks, small cap stocks. Now, I won't get into too much details here, but when I do the series, when I do the subsequent videos on this, we will talk more on this, especially when it comes to mutual funds, right? So, large cap stocks are companies which are big in size and they have been there for many years. Mid cap stocks are fairly new. Small cap stocks are very small companies. So, there is a difference in the way they give you returns and the risk that you carry. What are the advantages or importance in a portfolio? As we just mentioned, it gives high returns, it gives you dividend income,
Very important is that it's an hedge on inflation. When inflation is high, the stock markets actually give you returns which are more than inflation. So it beats inflation. And that is the fundamental difference between this and bonds and cash. And you get ownership rights. So you can actually vote for important decisions in the company. And the disadvantages of equities, as we just talked, it's volatile. Today it may go up by 10%, tomorrow it may even fall by 5%, 10%, 20%. So it is very volatile. In a period of 6 months to 1 year, you can see the market going up and down. It just doesn't go up or just doesn't go down. There are periods when it keeps going down, but then there are periods when it goes up, but most of the times they are volatile. There is a huge risk in the market. Anything happens in in the country or in the companies, there is a risk, like individual company risk. And you don't get dividend all the time. There is uncertainty because it all depends on the profits. And what is its role in the asset allocation? That is what we have been talking, and that is what is important for us to know how our money will grow. It's a growth engine. It's really the engine. Without equities, you will never grow. Your money will never grow. Your wealth will not grow. Equities grow by 12 to 15% compounded annualized returns. For example, in the last 1 year, or last 5 years, the market has gone up by 15%. In the last 1 year, it has gone up by much more than that. So it's a growth engine. You must have it in your portfolio. It's an inflation protector. It protects you from inflation. So as an asset allocation, it's a very, very important role it plays. It's also an income source and helps you diversify. So when you have equities, it's a different asset class when it compared to bonds or cash or gold, etc. So this is all about equities. So the next asset class on our list is real estate. I know this is a very favored asset class for many in India. And I've actually done a video on this called Three Properties, Two Mistakes, One Lesson. A great asset class has its own advantages and disadvantages. What is a real estate as an asset class? So real estate involves investing in physical properties such as residential, commercial, or industrial properties. Investments can be directly buying those properties or indirectly through REITs, that is, real estate investment trusts. What are some examples of real estate? Residential properties, where people live, families live. Uh, the houses that, if you have purchased your house, it's called a residential property. And there are commercial properties, like properties within malls or industrial estates, where people do not live there but offices operate from there, or manufacturing units or whatever, something happens there. As businesses happen there in those properties. And then finally it is REITs, which is real estate investment trust. What are REITs really? So REITs are companies that own, that is, they purchase properties, they operate or finance income producing real estate across a range of property sectors. They buy these properties and they allow individual investors to earn a share of the income produced through commercial real estate ownership without actually having to buy, manage, or finance any properties themselves. Very simple and easy way to own properties, where you don't buy, there is somebody who buys and gives you a share of that. So what are advantages of uh, or importance of having real estate in a portfolio? They give you steady income from rentals, appreciation. Every year real estates appreciate almost. They are inflation hedge. They actually go up along with the inflation, so they are a hedge. And they are diversification. They provide diversification, which means they're an asset class which is slightly different than equities or bonds. So there is no direct correlation, so they offer diversification. Obviously there are disadvantages of real estate, and we all know, all those of us who have real estate, they're illiquid.
You cannot sell a property tomorrow, day after, or in a week. The process of selling, liquidating property takes months or sometimes years because of various reasons. They have high entry costs, which means you need a huge capital to buy real estate. A lot of money to buy a real estate. In addition, you need to be ensuring that it is maintained. You pay the maintenance, you take care of the property, uh, often have paint the properties or renovate the properties or take care, because there is a wear and tear that happens in properties. And there is a market risk. Obviously, when there are issues in the country, or for example during COVID, property prices were down. During there's a when there is a recession or anything like that, the property prices fall. Now, specifically coming to asset allocation, when you have different assets and real estate is one of them, then how does it help? It helps you with the income source, right? Your portfolio gives you income through rentals, and it offers diversification. As I just mentioned in the advantages, there are uh, it's not directly correlated to bonds or equities. So regardless of that, so diversification basically means they should not be correlated with the other asset classes. So if bonds or equities are down, real estate may be going up. So it's a very good diversification. It's an inflation protector. Yes, in your portfolio should beat inflation, and real estates beat inflation. They give you a capital growth. They help you, their properties appreciate at 6, 7, 8, or 10% even in our country, in India. What is next? Commodities. Did you ever think commodities are also an asset class? Yes. Commodities. What are commodities really? So, commodities are physical goods that are typically interchangeable with other goods of the same type. They include natural resources and agricultural products. So, commodities are also an asset class which can offer asset allocation to your portfolio. So, what are the unique characteristics of commodities? They are tangible assets, unlike equities and bonds, where actually they are digital these days, and they are traded. You cannot touch and feel, but commodities are some things that you can actually feel. You can touch. They are tangible. They are an inflation hedge because they beat inflation. Cyclicality, they have their own cycles of going up and down. Sometimes they are up, sometimes they are down. So they're quite cyclical. They just don't go straight linearly up. And of course, diversification, they are not exactly correlated to equities, bonds, real estate. They have a very different, unique characteristic. So, what are some examples of commodities? Energy, oil, natural gas, metals, gold, silver, copper. This is something that we are all familiar with. I'm sure all of you have gold as and you consider that as an asset class in times of emergency or in times of need. You're willing to sell it. Uh, Agricultural products like wheat, corn, soya beans, and several agricultural products. So they're all examples of commodities. So, what are the advantages of or importance of commodities in a portfolio? Their inflation protection, they rise along with inflation. They are they are an asset class which is not directly correlated to other assets like equities and debt. They have high demand. These products have demand throughout the year, whether it's gold or silver or oil, natural gas, or any of these agricultural products. So they are tangible assets which have an intrinsic value, which means they have a value of their own. They do not derive from anything, but that is their value. Commodities, as like other asset classes, have their own disadvantages. They are volatile. They are not like debt. They don't go up linearly. They are volatile.
There are ups and downs. They are physical goods, so storage costs are also an element involved. They have market risk. Uh, they go up and down depending on what's happening in the market. They do not offer any income like the other asset classes, like equities or bonds. They do not give you any income, even like real estate. They do not give any income. Finally, again, going back to the role of commodities in asset allocation, they are an inflation hedge. Every portfolio should offer an inflation hedge, and these do offer inflation hedge. They are not directly correlated with other asset classes, so there is a sense of diversification. It has its own unique timing of ups and downs, and it can help manage your risk. So it helps in balancing the portfolio risk. Now, the final asset class, and these are called the alternatives. These are interesting. These are not so common among the retail investors, because alternatives, it is the mostly the high net worth investors invest in alternatives. Now, alternative investments include a variety of assets that do not fit into traditional categories like stocks, bonds, or cash. These can provide diversification and potentially much higher returns. That's why uh, the rich who have a lot of money can invest in alternatives. So, how different are they from the regular assets? And what are the characteristics of alternatives? They are non-traditional. That is the number one, which is the most important differentiation. They are non-traditional, which means they are not the usual investments that people think. For example, when you get your salary, when you save and you start investing, you invest in traditional, but these are not traditional. They are diverse assets. There are different varieties of assets, which we'll see in the next slide, and they have low correlation with the rest of the asset classes. Whatever may happen to the rest of the asset classes, these asset classes have no correlation. They are illiquid. Because of this characteristics of theirs, they are unique, they are illiquid. So what are some examples of alternatives? Private equity. When you are investing in privately held companies, smaller companies which are not public yet, they may be big companies also, but they are not public yet. So so they are high risk, and they are not liquid, because you are investing in companies that you cannot sell whenever you like, because they are not listed. They also could be venture capital, like investments in early stage high growth potential companies. But all these, they are non traditional, but they give you high returns. Hedge funds, various strategies like long, short, market neutral, and using derivatives, um, futures, and options. So, a lot of things are done in hedge funds. Real assets like art and collectibles, art, old paintings, coins, uh, first edition books, rare manuscripts. They're all collectibles. They're rare. They're antiques. Maybe an antique furniture, which may cost lakhs of rupees. So when you invest in alternatives, you are investing in these, and as the prices of these collectibles go up, and they go up in lakhs, so you gain from investing in alternatives. Then cryptocurrencies, which is a new fad, bitcoins and ethereum and a lot of all these different cryptocurrencies, they are also a part of the alternatives. So what are the advantages when it comes to your portfolio? There, the biggest advantage is potential for high returns. You get very high returns because you are investing in very high risky products. There is a huge diversification, which means there is no correlation with what's happening in the outside world. So whatever may happen in the markets, to the equities, to the bonds or real estate, they may not necessarily happen in these. Uh, there are unique opportunities. Alternatives gives unique opportunities which you otherwise do not get publicly. Hedge against market volatility, yes. Uh, However volatile the markets may be, but these provide the hedge, especially those derivative products. Yes, like other asset classes, they have their disadvantages. They're highly illiquid. As I just mentioned, private equities or venture capital, you cannot come out whenever you like. So, when you invest in alternatives, they are not liquid. You cannot withdraw from your alternatives when you like. There is a lock in. Fees are very high because of the high risk that the fund manager takes. They are complex. They are not very simple. They are complex. There are varieties of assets within the alternatives, and regulatory risk. So there is, since they are not traditional, the regulations around these are minimal, or they are few, and they are complex. So there is a huge regulatory risk. And finally, what is the role of alternatives in an asset class? Number one, diversification. They are not correlated to the other asset classes. So that provides that edge in the asset allocation. Risk management. It helps you manage your overall risk of your portfolio, because since they are not correlated, if the markets are down elsewhere, the equity markets are down, uh, alternatives are usually not down because of the variety of investments that it has. And of course, it gives you your portfolio the push, the stimulus to generate high returns. And finally, it gives you unique exposures which are not available in traditional investments. So finally, let's summarize what we've done. We've done a lot on asset classes. We have seen the major asset classes: cash and cash equivalents, bonds, equities, real estate, commodities, and alternative investments. So these are all the different asset classes. Each of them have their own characteristics, just like cycle, train, or aeroplane, or bus, car. They're all different. They are different. They have one purpose, and that is they'll reach you from one destination to the other. In the same way, assets have one purpose, that is to give you returns. Each of them have their own advantages, disadvantages. That is what we have seen. We've also seen their characteristics, and finally we have seen how they fit into the overall asset allocation, which is so important for us to grow our wealth.
Finally, as we come to the close of this session on asset classes, I hope you've got a gist of what it means. I'm sure you knew a lot before this, but this would have offered to you a new perspective. I hope it has offered to you a new perspective about what is the asset class, how important they are. So it is never a good idea to just have one asset class. As I already talked in my previous video on asset allocation, it's always good to have a variety, diversified investments, so that it provides you the right asset allocation. And our goal of asset allocation is to maximize returns and minimize risk. What did you learn from this? Please share me in the comment box. What did you learn? Did you like this? Did it help you understand? If you did not know really about these things, did it really help you as a family? What are your decisions? What decisions have you made based on this video? Please do let me know in the comment box. If you liked, please give a thumbs up. And if you have not subscribed, please subscribe to this channel. Um, as I mentioned, this is just the beginning. And over the weeks, I'm going to get in detail, deep dive into each of these asset classes, so that you know where you are investing. You know where your financial advisor is asking you to invest, right? Or your mutual fund distributor, or your financial coach, where is he or she asking you to invest? So it's very important, and then you will know which investment suits you. Even within each asset classes, for example, in equities, which are best suited for you. Is it large caps, mid caps, or small caps? Even within bonds, is it the short term or the medium term or the long term that is most suitable to you? Or even in real estate, what is suitable for you? Is it residential properties? Is it commercial properties? Or is it REITs? Or whether it is gold or silver or other commodities? And do you really need to invest in alternatives? So that is what we will do in the coming weeks. We'll get deeper into each of these asset classes. I hope you will stay with me uh, in this journey of understanding asset classes so that together we will build wealth. We'll build wealth for us, for our generations, and for this nation. Thank you. I'll see you soon.